90+% of every single commercial real estate transaction uses CoStar or one of CoStar's products somewhere along its life cycle. And so some of the companies that you may not be aware of that we own that you may use or probably use are LoopNet, Apartments.com, Homes.com, Smith Travel Research, STR Craig's familiar with that. We provide hospitality data to the industry. A wealth of companies that you may or may not have heard of. But as a result of all of that research, we actually are able to provide the industry with the data they need to make data-driven decisions. So from an investor standpoint, that may be finding information about a property they're looking to purchase. From a property manager or owner standpoint, understanding what rents are doing, right? It's actually the largest listing platform as well. So if you are a broker and you're looking to list a property, you don't put it on the MLS, you put it on CoStar, whether you're trying to lease a property or sell a property. In addition to that, with all the analytics we provide, we're able to provide that information to banks and provide advanced credit default models to banks to manage risk on their loans as well. So pretty much all through the life cycle of a transaction, including the lending portion, we are there to provide the data you need to make those types of decisions.
Perfect. Tom, I think you got your mic working now. How are you?
I do. Can you hear me?
Yes, we can.
Okay, much better. I apologize for that.
No worries.
My name is Tom Curtis. I'm a commercial real estate appraiser. I'm a director with Curtis-Rosenthal. Been appraising for over 35 years. We appraise all types of properties, retail, office, industrial, multifamily, vacant land. I've developed a specialty in schools recently, and we cover the entire Southern California area, sometimes get up to Northern California. I had been a licensed in Nevada and Arizona for a while, but not currently. So that's kind of a background on me.
Perfect, Tom. Appreciate this. Okay, Fred, what are the biggest challenges facing borrowers out there today?
Yeah, that's a great question. And yeah, it's really challenging because people are having difficulties getting the leverage that they need, especially when we look at the type of financing that was done 4 or 5 years ago. We were using lower cap rates, right? You're probably in the 4% range for multifamily and other products, but now we're looking at a cap rate in the 6.5% range. So when loans were originated back 4 or 5 years ago, we were typically at about 65% of that value. Now we look at a situation where higher cap rates, if we do the math, we're going to be at the 65%, the same amount. So really there's just a shortfall. So borrowers need to bring in capital because most of what I see out there when the commercial loans they have a 5 or 10 year term to them and they need to refinance, and there's just not that they have that shortfall and there's not that leverage out there coming from one source.
So how are you dealing with that? Are you allowing a second? Are they bringing in just more private equity and or a combination of all of the above? What are you seeing out there for how are they getting to close that gap on that shortfall?
Yeah, I think that they have to just realize that it's not going to come from one source. And so, like you said, Craig, it could be a situation where they do a little capital call, and then hopefully the lender will allow a subordinated debt piece.
Right.
I know at Axos Bank, that's what we do. We typically will allow for a subordinated debt piece, and that could come in form of many different things, mezz, pref.
Now, are you also allowing in the states that have that where you can get that that additional money put on the tax roll?
Oh, elaborate a little bit more on that. What do you mean?
It's typically, instead of a second, it's a commercial piece where it gets built into the tax roll. Typically, there's an energy component to it, and it's a little bit cheaper than
financing.
Like PACE,
yeah,
I see what you're
PACE,
saying.
yeah,
PACE, right.
yeah.
Okay, yeah, we I know lenders out there that is a viable option. we will consider PACE. And in the past, we have not, because I guess technically PACE will come in first position. But the reality is, if the total leverage is within an acceptable level, we will go ahead and consider PACE. Yeah.
Definitely. I think the saving grace with that is typically if you've impounded the taxes, they're not going to default on it. So,
right. Exactly.
That's, so it's one of those scenarios that can really help out, and it's relatively cheap money as well.
True.
Tom Curtis.
Yes.
Property. You're analyzing property. You've got the property owners providing you with a ton of different materials. How are you, what is your methodology of getting to that appraisal, getting that completed? What do you need from your owners?
We're looking at a property. It's basically a snapshot in time.
Yeah.
Sometimes we get requests. A lot of times it's for current value. A lot of other times it's for a retrospective value when we do estate planning work or date of death appraisals or other issues, or maybe it's a prospective value in the future when a building is completed new construction that hasn't happened yet. So, to start with a current value, usually we want to know about the property so we can tell the story.
Yeah.
I want to know, I want to see the leases and the rent roll. I want to see the past 3 years of historical operating statements so that I can project, the next year into the future. We love to see some building diagrams and such if possible. But really just to know, and I always ask, what does the owner think of the value of the property, and get some feedback from them, and kind of decipher that if it's good information that they have, or they're really relying on me to come up with a value. So that's just kind of a start of it. It's always one-off. The deals are not the same. Everything's a little bit different. So
now, what about market rents versus rents that are already in place? How much of that do you take into consideration?
Well, I guess in the past we've gone through some cycles where rents all of a sudden drop off, will go way down. So I've become more aware of first looking at the property as if stabilized with market level rents for all the spaces, and then coming up with a value as if stabilized at market rent, and then looking at the contract rents and saying, comparing them to say, this is above my market rent estimate or below my market rent estimate, and then discounting back the difference for the length of time remaining on the lease. The thing to think about in these appraisals is that when we do an appraisal, the assumption is that there's a new property owner. So he's getting whatever leases that are in effect at that time.
Right.
That's what the new owner gets. He gets to collect that income. And he, can make changes in the future, but at the time of the appraisal, that's what's in effect, and that's what we use.
Is there an as-is condition at this point? I mean, yeah, it seems like lending practices are changing dramatically from week to week. What was the flavor of the week this week may not be there next week. The bucket may be filled with loans on that particular asset class. So is there an as-is condition with these lenders that you're saying?
Sometimes the lenders will ask specifically for an as-is value. So like I said, we first look at it as if it's fully stabilized at market rent.
Right.
And then we look at the differences between market and contract, and also the differences between our stabilized occupancy rate versus the actual occupancy rate. And if there's some space that needs to be leased up, then we're going to make some deductions for the time and expense to get that space leased up.
Okay. Client communication. I've been doing this for over 40 years total, and I don't know a lender, an appraiser, or a title company, or an escrow that has not complained about not getting all the data that they need from either the borrower or the seller in a timely manner. What is that like? I mean, you've got to have open communications with your clients. You've got to have availability to data. Especially right now, it's got to be very critical.
When we kick off an appraisal assignment, it's great if we have all the information to start, and the clock can start ticking. 2 or 3 weeks to get the deal done. But in our minds, we're thinking, hey, we don't have all the information. Is that clock really started ticking yet? We want to get it all up front and get started and be able to go out and see the property and start our analysis and not have a bunch of missing pieces to the puzzle. But communication is key. You know, I like to be able to talk on the phone or email, but just try to be as responsive as I can to keep the deal rolling along and get it to the finish line.
Do you find it being more helpful or more of a hindrance if the property owner is there with you and helping you tour the asset?
You know, it's helpful. It's helpful a lot of times to have the owner or a representative there, that if there's multi-tenant, I'm going into different tenant spaces and taking photographs and such.
Yeah.
They're introducing me and saying, hey, it's okay to let this guy in and take a photo. We're, you know, doing an appraisal analysis. If sometimes I'll go by myself, and then they will have already let the tenant know that I'm coming to do this and it's okay to let me in. So there's different ways to go about it, but it's okay. Sometimes I can do it without being escorted through, but sometimes it's nice to have somebody there as well.
I love it that a named partner is staying current and still going out in the field and doing appraisals. That's a hallmark of a great company. It really is.
Well, to be honest with you, I am not Dave Rosenthal's partner. I have the same last name.
Ah,
Partner
okay.
Bill Curtis passed away like 15 years ago. I've been with the firm for 30 years. There's no nepotism. I was not related to Bill.
Ah, okay. Thank you for the disclosure.
There you go.
John MacLean, my friend, I've closed deals with your company, and you've been able to get it funded in 72 hours after checking a pulse and an SI. So cap rates, SoCal in particular, what are those transactions like? What's happening with cap rates right now?
Well, actually, I was hoping Tom could talk about that. The cap rate side. I mean, obviously the cap rates have been moving up, but Tom, if you have a couple of minutes, maybe you can give us just some thoughts on where cap rates are for the different food groups, whether it's the apartments and, you know, office, industrial.
You know, I don't have any specific cap rates. It all depends, as I like to say, is the answer to any appraisal question. But obviously cap rates have been moving up as interest rates have been going up. So there's no getting around it. Yeah,
we've been trying to figure out, because again, we're an equity lender, so we're always looking at values. A lot of times, and I don't know if Tom would want to hear this, but a lot of times when we're finding property or transactions, we don't need an appraisal. If, you know, a lot of times we're looking at a property that's worth a couple million probably, and we're doing a, you know, 800,000 or 500 or something like that. A lot of free and clear properties. So then we don't really worry too much about the, you know, where the value is, because we know, well, it's at least, you know, X amount, and we're going to be fine. But when we're doing properties or transactions, say there's one in, you know, Montana, or it's not in Seattle, it's not in Tacoma, but, you know, it's in Washington. We're not as familiar with the area, obviously. That's when we're definitely looking at getting the appraisals and looking at the cap rates on that. So yeah, Craig, that was my question, was on
I like to stay in
cap rates.
Large metropolitan areas where there's lots of information. But even now there's this, you know, a slowdown in the number of sales transactions and lease transactions. So that information is harder and harder to come by. But we have to, you know, use the data that you have and talk to people and look at listings and things like that, and see, kind of have a better gauge of what the actual cap rate should be.
Tom, can I ask you a question? How are you handling office with values declining on the office type and cap rates expanding so quickly? How would an appraiser handle that? Are they doing forward projections?
Well, once again, you know, we're looking at the property. I start off by looking at it as if it's stabilized at market rent, and market rents have been going down. And then looking at the actual status of the property, what the actual occupancy is, and trying to figure out how long will it take to get leased up at this market level rent. And so those are projections, and I don't know, it's difficult to, how much trust can we really put on that? I mean, it's usually a pretty big discount. I don't know, even, you know, we looked at CoStar, we use CoStar, but CoStar has these stories every once in a while, and we're in a kind of a class A, B office building and near LAX. And CoStar does a story, hey, look at this building for sale. The buyer wants to turn it into storage space. And we looked at it, go, oh, that's our building. What the heck's going on? It later sold to partial owner user that took the top floor for themselves and are continuing to lease the building. So it's not converted to storage space, but you know, there's just kind of, it's an odd time in real estate, let's say.
Yeah, it is, without a doubt. Hey, you know, John, you're lending on all the asset classes across the board. You're able to get loans done quickly. You've got lack of capital availability with many lenders. They're having a tough time getting their loans approved, requiring the borrower to have bank deposits. Are you seeing any of that change, or is that driving more business towards you?
Yeah, we're busy right now. It's funny because I was at Chase for like 20 years. And although they're doing some refinances on their books, the banks are definitely having difficulty right now. You know, if you think about all these loans that we were all making over, say, the last 5 years, if you go back to 2019, so 5 years ago, if Chase or you made a loan at that time, you were probably, if you did a 5-year fix, you were probably around in the low fours, maybe 4.25, possibly a little under 4. But that loan, that 5-year fix, is adjusting to maybe a 225 over what was the 6-month LIBOR is now SOFR. Those 4% or 375 or 4.25 rates, those are adjusting pretty much every day. All those loans are going through that 5 or that 7-year fixed rate term is going away, and it's becoming an adjustable, and they're going to 7.5 or 8%, or, you know, kind of in that range, even a little higher than 8. Yeah. So with that, every single day, the lenders are seeing loans that are, and of course they're monitoring them ahead of time, but they're watching, like, okay, tomorrow we're going to have 20 loans go from a fixed rate of, say, 4% to 7.5%. And when that happens, you know, we get the rent rolls, we're monitoring the loans, and we know that the cash flow, it's not so much it doesn't cover, because a lot of times the cash flow does cover, but it doesn't cover the minimum debt coverage ratio that the lenders are looking for. And when that happens, which is happening, like I said, pretty much every day for all the lenders that made loans, you know, 5-7 years ago, that loan is going to have a higher risk rating, because now it doesn't have a 125 debt coverage. There's not a lot of cushion on that. It's probably less than that because the rates moved up so much. And over the last 5 years, the rents probably have not, you know, moved up as much as the rate is now doubling on those loans. And every day as that's happening, the banks have to pull money in and put it on reserve for all of these loans. So that's the whole issue that's going on with the banks, is although they may have cash to loan, or they would like to loan, every day they've got more loans going into the bucket of where the risk ratings are higher, and they have to pull in a percentage of their cash to hold in as capital to offset these loans that are now have high risk ratings. So yeah, that's the challenge that the lenders have. And it's not something that's going away, because if rates start dropping, everyone will start refinancing their loans, but that's not really happening right now. So there's not a lot of good solutions out there for the lenders. It's not like these loans are going to pay off if they're an adjustable at 7.5%, and the borrower wants to get another loan. They may have to pay down that loan to get another loan. Yeah. So that's what's going on with the lenders. That's what's going on with the money that they have. It's going into their capital reserves. And so, yes, because of all of that going on, we're in a good position. Our rates are higher than the bank rates, but if I just take a transaction, a commercial building, I had someone call in, they were 90 days, I think it was over 90 days since they had started with, I won't say the bank, but a bank, to get financing on a commercial property. They were looking at 8.5% rate, 25-year amortization, and they weren't getting the approval. Their loan amount originally was $1 million, then it was 900, and it was probably going to be 8. And now the question was, actually, will they even get financing? And I was able to look at that and say, look, our rate's going to be higher, no doubt. We're going to be at 10.75. I think we're 10.875 on that. But we can give you a 5-year interest only. There's no prepayment penalties. So we can come in, do the loan quick, and we'll probably give you maybe that same 800,000 on it because it's a low, 50% leverage at that point.
Right.
And, no personal guarantee. So we can do that quick. And then in a couple of years, we all figure rates will come down, probably not where they were, a couple of years ago, but they'll probably come down from the 7s and 8s, maybe into the 6s. Maybe they dip into some of the 5s and the high 5s. But at least for that type of transaction, yes, we're able to refinance it. We have no prepay. We can do the loan, and then maybe in a couple of years they come back and they, rates are lower and they're locking in a 6% or 5.5% or whatever, and then they can get that 5-year prepay, and it's not as big of a deal. So this market is really advantageous for us. And then I'll just flip it over on the other side. All of these loans we make, these are trust deeds, and we sell the trust deeds. So, I've got a loan right now. I'm going to do $700,000 up in Oakland on an apartment building. It's actually condos. We just got the appraisal back for $1,580,000. So it's 44% LTV, and that trust deed's going to pay 9.375%. It's a 5-year interest only. That's the investor net. So if someone said, hey, I'll put me down for half of that, I'll do 350. Someone says I'll do 200. And then, we get another 150, whatever. And that trust deed is out there. It's a 5-year interest only, 5-year term. I don't know if it'll last 5 years. It may get paid off before that, but it's a low leverage investment. And so that's the flip side. Every loan we're making, we also have these trust deeds that are available. So it's a great investment when you're looking at these, especially if you've got an IRA, because if you can get 9.375 on a 44% LTV and apartment building with cash flow and all of that, that's a pretty good return on your investment. So that's kind of the flip side. That's like the other fun piece that I get is, I had a church that I did a loan in Azusa, and we did $160,000. It was like a 20,000 square foot lot. It was an old church. It was not a beautiful building by any means, but it was 160. I think it was I forgot if it was 160 or 165, nice. But small loan amount. And, what a nice trust deed for someone to pick up. I gave it to a broker buddy of mine that said, hey, I got 200 grand. Let me know if something comes up. And I sent him this, like, oh my God, yeah, I'll do that in a minute. So there's a lot of different things that we're able to look at in the market. I think for Fred and I both, we're able to do these deals right now, get these loans through. So it's a good market for us.
Good. I love it. Kym Tran, CoStar. I love your comps. I've been using them for decades. You got better comps than title companies for sure. Do me a favor and tell the audience about some more of your products that are available to them, and then also what you're doing to help the lending community.
Yeah, so I guess just a few comments about the stuff that all the other gentlemen spoke of, which, I hear about that all the time because in my role at the company, I work in the lender services division, which basically means I spend all my time meeting with banks and credit unions and private lenders. And so I get to hear all the horror stories, but pretty interesting indicator, those of you who've been in the banking world know about, is the job role turnover from origination and sales over to special assets and portfolio management, right? So this is a shift that occurs when the cycle turns over. Banks aren't lending, and they're trying to prevent having to write down all these loans. So these special asset divisions continue to grow and grow. So there's actually a conference that's put on by IMN. It's called the Bank Special Distressed Assets Conference. I don't know, some of you guys have been there. But 2 years ago, it was all hobnobbing, networking, cocktails. Last year, it started getting a little crazy. People were kind of running around like, I don't know what's going to happen. It's happening in like 2 weeks. I'm going to be really interested to see what the tone of the conference is like, because there's going to be a lot of bankers there who have no idea what to do. All these syndicated multifamily loans that were done a few years ago, basically with free money that were barely penciling out at the time and getting lent on because of wishing and dream that rents would go up and values would go up exponentially forever and interest rates would not go up. Those people are all in a lot of trouble.
Yeah.
And so the banks are continually trying to figure out what they're going to do. Step one is identifying how many of those loans they have. And the scary fact is a lot of the banks don't know what they have, right? They don't know where the risk lies. Even their risk rating systems, which I deal with the banks, their risk rating systems, their stress testing of their portfolio, even their CECL calculations, a lot of them don't.
That's interesting that they don't. It really is. I think there you go, Kym. You were locked up there for a second.
Sorry. Anyway, so in this environment where things are changing so quickly, valuations, rents, hopefully interest rates will go down, but that seems to be the biggest driver here of all this pain. You would think that it would be more important to have more updated, more relevant data and more granular data when you're doing your examinations on the loans. And that's something that the regulators, me talking to the regulators, they are starting to really turn the screws on the banks. And so banks, just to give you an example, may have previously said, I'm going to measure the risk of all my multifamily loans in Los Angeles. I've put together a risk model, and I'm going to, discount everything by 200 bips here and a percentage here, whatever, what have you. Well, the problem is that we all know that rents and vacancies in Santa Monica are much different than vacancies in Yucaipa or over in Thousand Oaks, right? But when the bank's measuring risk and applying a vacancy rate or a cap rate across the entire Los Angeles basin, then they're not really seeing that risk. And so I expect there to be a lot more pain coming up in the next couple of years. Many lenders are being proactive about it. Some of them are not. So we'll see how this all shakes out, but it'll be interesting to see, and I'll be happy to share with what I learn at the conference in a few weeks.
Perfect.
Kym, what sort of proactive steps are they taking that you've seen?
Yeah, so when I mean proactive, it's actually just going in and doing things that they haven't done from a risk management perspective on their portfolio, right? So a lot of banks, especially on the smaller end, community banks, even credit unions, they operate on a status quo, right? They don't make changes to their processes unless the regulators come in and say, you need to make changes to your process, right? Or they don't make changes until they're unable to lend anymore because they've hit certain caps or, they don't have enough deposits. And so a lot of banks have been reactive to, whatever is being thrown at them. The ones that are being proactive realize that these changes are coming one way or the other, but more importantly, they need to assess the risk of what's actually on their balance sheet, like in ways that they haven't in the past. What worked for the last 10 years,
right,
not going to work in the environment moving to the future. And it's not only that, it's that everybody's getting more sophisticated too, right? All the investors are getting more sophisticated. The private lenders, they're able to move more quickly. So John, doing a great job. The private lenders I talk to, they're all busy. Now, does busy equate to good? Being busy right now is better than nothing. But But you compare that to a bank where it's just crickets, right? A bank like Axos, you guys are a lot more flexible and have many more products and ways to do deals. So unlike traditional banks, you're in a much better position. But yeah, so how this relates to CoStar is we provide the most data anywhere for commercial real estate. We get somewhere in the range of 10.9 billion new data observations in the platform every year on CoStar. And so to make that number even more understandable, on multifamily data, we get about 1.5 million rent observations every single day in the platform. And so, if you're a multifamily investor or a lender and you want to understand what's happening with current asking rents in the different markets or how that compares to, vacancies versus stabilized vacancies, what's under construction, all of those little bits of data are extremely valuable and can make or break a deal. One thing that I've actually been seeing people use CoStar for more now on the origination side is actually, even after ordering an appraisal, they will still monitor future comps. They'll use CoStar, set alerts to see if there's any future comps that occur on around that subject property that they're trying to do a loan on, so that when it gets to loan committee, maybe they're not going to have to flip a coin on a deal, or it's going to be more of a slam dunk, or B, maybe there's nothing that's ever going to happen on a deal, right? It's more challenging for guys like Tom over there because there aren't as many transactions. So you really need to know every little thing that's happening within a market and extrapolate. You can't just use comps anymore to come up with a valuation. You need to do an income approach. You need to do many different things to really, things that Tom could talk about all day, I'm sure, to really get you a good valuation. And you can't do that without data. So data, I mean, we're essential to a lot of people in the industry. The other thing that we do at CoStar is we have a different platform for lenders specifically, and that's where measuring of the risk of loan portfolios occurs. And so we actually will load a bank's loan tape, their entire CRE portfolio, merge it with the CoStar data, and then run it through some advanced credit default models to help banks understand where the risk lies within their portfolios. Even things like tenant risks, and I'll give you a good example is, I met with a chief credit officer at a bank, I guess a couple months ago now, a few months. And somebody from the board of directors at that bank had been watching CNBC that morning and had heard that Dollar General or Dollar Tree, one of those, I think they're the same, was going out of business, shutting down a bunch of stores. And so he called the guy on the board of directors, called the chief credit officer, and simple question: how much exposure do we have to Dollar General, right? Well, what happened was the bank then had to pull 4 portfolio managers off the floor for 2 days to comb through every single loan, and they have CoStar data, but they don't have our new product. So they had to go into CoStar, look up each property, look up each tenant, go into Google, do all that stuff in order to come back to them and say, oh, we've got 20 loans, retail centers with exposure to this, right? That process in our new platform literally takes 30 seconds. So if you were a banker, and I showed that to them, and so now they are going to be moving. One of the things that we do well is when things change within the economy, within the real estate cycle, with needs of regulators, we're fortunate to be a big enough company where we can still build whatever needs to be built so that we can provide those services to our clients. So
Perfect.
I know it's kind of long-winded, but hopefully it was interesting information for you guys.
Great information. Hey,
Great.
Fred, what's your favorite asset class to lend on right now? And how long is it taking you to get a deal funded?
I'll tell you, in the past it was multifamily, and the multifamily asset type is fantastic. But right now, my favorite is luxury homes.
Really?
They can be
Huh.
new, yeah, luxury homes, and they're usually they're spec homes that were built. You know, you could be looking at 20, 30, 40, $50 million homes, and they were either looking to do a flip on them, or it could be a bridge to sale. Right now, things are are a little soft on the luxury end, so there's plenty of equity in these homes. So right now, that is our most popular asset type right now. So I've done many. We financed many mansions in the West LA, uh, Beverly Hills, even New York, because we are nationwide. So
Right.
yeah, we can go in and structure something where like we can offer a 12-month bridge loan with a couple 6-month extensions. So we can actually gear it if they need more than that. It could be 12 months, it could be 18 months, 24 months, fully funded, so they don't have to worry about making the payments. And when the time is right, they get the right buyer or their exit, they can just simply pay us off. Now, typically that program does come with a make-whole agreement. So, we usually throw in a 12-month make-whole agreement, but everybody that I've spoke with, they're fine with a 12-month make-whole. So it's kind of like a quasi prepayment penalty. But after that make-whole agreement expires, then they can do whatever they like. Yeah. So definitely the most popular right now.
Nice. Now, are you having any post-funding liquidity issues or requirements for borrowers?
We do, but there's nothing, at Axos Bank, everything is in the black. It is not black or white. We operate in the gray. Certainly we want to make sure that they have plenty of liquidity post-closing, but we vet our deals more carefully now than ever. So really what we're focusing on is the global cash flow of a borrower. Okay. And when we delve into that, it is not just taking a look at the schedule of real estate and looking at what the cash flow was doing, 6 months ago, because we are now looking at resets and maturity dates. Because as John touched on it, I mean, you're looking at rates jumping 200, 300, 400 basis points. And so how does that affect the cash flow moving forward? So we get into the details of that. So I encourage my brokers that I work with is to get that information up front, because it's not just Axos Bank. There are other banks out there that are looking at this, and that can trip you up at the end. Like, okay, they might be asking these questions 3-4 weeks into the process, and then all of a sudden you get a denial. It behooves them to go ahead and get this information up front on every single real estate loan a borrower has. This way you're prepped and full disclosure. And so, on top of post-closing liquidity, and now at Axos Bank, we don't have a problem with cash out. That's easy. And we can use the cash out to meet those minimum liquidity requirements. But more importantly is that global cash flow.
Perfect. Thank you. Tom, what's your favorite asset class right now, and how quickly or how much time do you need to get your appraisal done?
My favorite asset class has always been a triple net leased investment with a brand new long-term lease. Not too many moving pieces.
Yeah.
Usually I think we're quoting now like 2 to 3 weeks to get a deal done, depending on how much workflow we have at the time.
Very good. What's the biggest monkey wrench you've had thrown into an appraisal, this year? I mean, there's been a lot of them, but there's certainly been 1 or 2 that have got to come to mind that have just, put the whole deal on its ear.
I think one, I had a guy that owned or was buying a piece of land, and it had some environmental issues, and he wanted to convert it to a very dense multiple residential development project. But I asked him, I need to know very specifically what you're building, how many units, what the unit types are. Probably need a market study from him to really know the sizes and things. And he just didn't have any of that information, specific information. So I kept telling him, I need to know what I'm appraising. If you don't give it to me, I can't make it up. And that thing just kind of went away after a while.
Wow. Thank you, Tom.
Now there's a bunch of cars parked on that side.
Yeah, well, he's making some money somehow. So, hey, John MacLean, how quickly are you getting deals done? And what's the most popular asset class in Fidelity Mortgage Lenders portfolio right now?
Well, similar to what Fred was saying, the single family residential is, those are pretty easy transactions to do. We're definitely not doing the 25, 30, $40 million loans that he's doing. We're fine with the little, small potatoes. We probably do a lot more under $1 million loans than we do over, I would say, $2 million. So we're fine with the rental property. Someone's got 3 or 4 properties in different cities or around, and we'll look at how much are they getting on the rent side as well. But so we do a lot of those. We get a lot of commercial properties though, and I'd say like retail. And the office, we are doing office. I mean, we're not into the big, A, B class office building that has multi-tenants and multi-story and all of that. We kind of like the suburban, owner user, single tenant or a couple of tenants, stable, medical, all of that. We're good with that. On the retail side, we get a lot of the smaller retail centers. It might have a cannabis tenant. And we're okay with that. I mean, I had a property, I think it was in Inglewood, and it had a cannabis tenant, and we still were offering a 50% loan. I mean, we could potentially go a little bit lower, but the rents were not that much higher for the cannabis tenant, and the other tenants were all long-term. So it just kind of looked like a standard type retail property. And then, we're offering a 50% loan. So these smaller transactions, I would call them like base hits. Those are the ones that pay the bills. They're quick to go through. A lot of time, if it's a purchase, and we're doing 50 or 40%, especially 1031 exchanges, things like that. A lot of times we don't need an appraisal, or we get a quick restricted appraisal. Honestly, Kym, we work on CoStar. I was on CoStar last night, just pulling some comps on some properties. I pull the sales data, and then I can look through and see their price per square foot. I love CoStar. I mean, I use it all the time. I can just get quick information. And I just call them data points. I look to see what CoStar's got, what cap rate they have. Now they may have 30 properties over on this list that have 3 years data, and that cap rate could be a little bit older, but I can dive into the sales and then see, well, what is the average cap rate, price per square foot, or whatever I'm looking at on the 5 transactions that were done in 2024. And then I just kind of quickly look at that. So it's great to have all of that data and those tools available to us. But yeah, so I would say we're doing a lot of residential. They're easy transactions, and then commercial as well. I will mention on a deal we're doing, which it sounds a little outside. I've got a loan. It should fund. I think it's going to fund tomorrow. And it's a $4.4 million loan on a 73 acre parcel of land in Hemet. They're going to build a 750,000 square foot industrial distribution center with 96 truck bays. Wow. And the guy that's buying it, he was in escrow with the city of Hesperia for 3 years while he got the property entitled. And he's got 4 offers at 22 million. We had an appraisal done that we came in with a conservative, I would say, appraisal at about 18 million, and we're doing a $4.4 million loan. So, nice. We're still low leverage on that, but so there's a lot of different transactions that we can look at. The funny thing on that one is, again, you go back to the story, is if we all remember when the ports, when all those container ships were out there, the ports were negotiating their contract with their truck drivers, all of the unions, all of that. So I guess one of the provisions was, if you are delivering your goods off of the ship within 70 miles, you had to use a union truck driver.
Wow.
And this building is 72 miles outside of LA, right? So that's what happened, right? So yes, something like this, they're gonna build a whole bunch of these. There's another one going up across the street, but that's like a transaction that we're doing. We set up a 12-month payment reserve. The guy
Nice.
wanted a 12-month loan, and we said, how about 18 months? Because we don't wanna have an issue, and we also don't wanna have to go back to the investors if 12 months is coming up and it's not worked out. But that thing will probably be paid off in 6 or 8 months, but he had to close with the city and then he can turn around and sell it. But that's like another transaction that,
Yeah.
we can do if it makes sense, low
Right.
leverage and all of that. Yeah.
Very good. Okay, Kym, what asset class is just scaring the hell out of you right now?
I mean, office is the obvious answer here. Class A office,
Yeah.
in downtown, central business districts. I was actually up in San Francisco last week, and although some people are coming back to the office, um, many offices are just vacancies well above 40%. Like just beautiful high rises that, 4 years ago would have been slammed are
Yeah.
just there's nobody there. And I think the people who are there are only there because their companies are making them be there,
Be there, yeah. Now,
know.
it's funny because you look at Century City, it's on fire. It seems to
Yeah, it's
be,
fine. Century
it's
City's
doing
good.
great. You look at downtown LA and you're going, why am I here? So I mean, are we 5, 10, 15 years or more out before those markets come back, or do they make a right-hand turn and adaptive reuse where possible, or scrape and something new come up? I think it's going to be, personally, professionally, I wouldn't invest in an office building. I'm just not going to do it. I think it's too risky. I'll stick with hotels. I'd rather make sure my guests are happy than dealing with the instability on the office space. So we've only got a couple of minutes left, so I want to go around the horn. Start with Fred. Fred, are we going to have a cut in interest rates this year post-election? Because it's not going to happen prior.
I don't think there will be a cut, but I'll tell you, all the banks, regional banks, we are praying to reverse this inverted yield curve. It is critical, just because we look at the interest margins and we can't have them dwindle. So I unfortunately don't see that happening. I hope they do, and but I do expect to have something change in next year.
Thank you, Tom.
Ask me the question again, please.
You think we're going to have a cut in the interest rates after the election? It's not going to happen beforehand. Fed's already said that.
I don't see a cut in the interest rates in maybe another year, in my opinion.
Interesting.
Mm-hmm.
John?
Well, I think
I know you want them up there. I get that.
Yeah, we're fine. We're fine with them being on the higher end, I guess. Keeps us busy. But yeah, if there is, maybe it's 0.25%, but it's not going to change much of anything. I don't think we're going to see that much difference. Definitely this year and in the first or second quarter. Maybe we get 25, 50 off, but that's not going to change everything a lot.
No. Kym?
1 in 4 chance.
Okay.
I gotta say,